Hi, my name is Keith Cooley. Today, I'm going to introduce you to reserve management for community land trust properties. I spent 7 years at the San Francisco Community Land Trust as Director of Asset Management until I left at the end of 2022. I was responsible for the management of reserves for the entire portfolio. During my time at SFCLT, the portfolio of properties grew 100%, and the amount of reserves under management grew to approximately $2 million. Today, I'm going to cover why reserves are needed, the types of reserves, how to track them, where to hold reserves, making contribution to reserves, spending from reserves, and best practices. Reserves are important in the management of property because the expenditures needed to maintain and manage a building, especially over the long term, cannot be funded solely from monthly operating income. Reserves are helpful to cover the costs to deal with unexpected costs or emergencies. For example, a sewer line floods a property. It can be very expensive to replace a sewer line and do flood restoration. Reserves are needed to pay for the replacement of major parts of a building, such as a roof, when the expense is too large to be funded from operating income. Developing healthy reserves for properties is a key financial milestone to building a sound, sustainable portfolio, and should be one of the first priorities to enable a community land trust to move out of a scarcity mindset. What are the different types of reserves? One of the most important is the replacement reserve, sometimes called a capital reserve. It provides the capital funding necessary to replace critical parts of the property and making essential improvements, such as installing a fire alarm system to keep a property in compliance with changing code requirements. Another type of reserve is the operating reserve. This is intended to provide a buffer to monthly cash flow. It's used to keep a property's monthly operations going in case of a revenue shortfall or an emergency situation. As best practice, CLTs should set aside enough operating reserve to fund 3 months of regular operating expense. Other types of reserves commonly in use include vacancy reserves, typically required when 1 or more units are kept vacant and there's going to be no rent for several months while the units are being renovated. A debt service reserve, similar to an operating reserve, but more focused on providing funds for debt service, that is the loan payments, when rent revenue is insufficient or falls short. Reserves are often mandated by a lender or by the city or county agency that you are working with. The details of the contributions, those amounts will be defined in the regulatory agreement or loan agreement with the lender. Best practice is to track the incoming and outgoing from the reserves. A spreadsheet tracker or similar should be used to keep a record of contributions and spending from reserves. the details of any expenditures with associated invoices or estimates for the work. This tracking documentation needs to be well organized and easily accessible for your auditor, or if you are audited by the lender or city or county agency who provided the reserve funds. How to hold reserves. When a property is acquired, it's likely that the lenders, whether they're a bank or a CDFI or a government agency, will prescribe how the reserves are to be held. Typically, it will be in a separate interest-bearing savings account. If there's not such a covenant, then it is a missed opportunity to store the entire reserve fund in a simple savings account. The reason is that reserves are usually held for long periods of time, and inflation can dramatically impact the buying power of your savings. Let's do some quick math. $1 million in a savings account with the current inflation rate of 8% means your organization could lose $80,000 of buying power in this year alone. In a savings account, that money could lose 10 to 15% of its value in just 5 years. Thus, as a best practice, most nonprofits should plan to invest their reserve funds in a range of places to maximize their value and to retain buying power over the long term. Let's look at contributions to reserves. For replacement reserves, the best practice is to look out for 20 years and define the replacements and capital improvements needed. From that list, the costs can be calculated and how much of the reserve is needed. This is a somewhat complicated undertaking, and it's best done by a professional firm specializing in reserve studies or capital needs assessment studies. Initial funding of the reserves will be based on when the replacements are needed during the 20-year timeline of the study. And from that, we can get a figure for the contribution for the reserves. Depending on the size of the property, the contribution will be done on a monthly or quarterly or annual basis. For operating reserves, the minimum balance required will be adjusted annually as operating costs increase over time. Usually when the reserves are established, it is also defined on when and what the reserves can be spent on. For replacement or capital reserves, the spending will only be for replacement items or capital improvements. There may be covenants on the reserve, or they may be held by the lender or the city or county that you're involved with, and they will require their approval before spending. The covenants and how you do in complying with them will be examined and reviewed by your auditor. When spending reserves, it is essential to retain backup documentation, such as invoices for the work, plus payment details. A copy of the check, a record of the ACH transfer, or the wire transaction must be kept and stored for your bookkeeper, for the financial auditor, and for the city or county agency that is monitoring you. In some cases, it might be the state or HUD that need this documentation at the end of the year. For an operating reserve, before spending, best practice is to have a plan in place to replenish the expenditure from the reserve. For an operating reserve, best practice is to have a minimum balance, which is 25% of the annual operating expenses plus debt service. When funds are spent from the operating reserve, the fund should be replenished as soon as possible, and certainly within the fiscal or calendar year. So in conclusion, reserves are a critical tool for ensuring the long-term needs of CLT-owned buildings are met and must be planned for at the time of acquisition.